I appreciate you coming to our class today on Social Security. We've done a class on Social Security, timing is everything. Now today's 5-minute or 10-minute class is going to be on not only timing, but tax planning regarding when you take Social Security. It's so important to make the right decisions in retirement so that you can look back, when you get to age 80 or 85 and say, look, I made the right decisions. I have no regrets regarding when I turned on my Social Security. Every financial decision you make should have a question in the back of your mind is, what's the tax ramification of this decision? And so Social Security is no different. So today I want to talk about Social Security. Let's first talk about the basics of Social Security. Let's bring that into our screen here. And Social Security, the taxes, how does that affect your Social Security? Well, folks, it's all about what is your provisional income. The more provisional income you have, the more taxes you're going to pay on Social Security. So if we can get your provisional income down, we'll pay less tax on our Social Security and less tax on our other income. As you can see here, if you're married and your income is over $32,000, you pay, or under $32,000, you pay no tax on Social Security. That's where we want to get to today. If you're over that, up to half is going to be taxable, and then up to 85% of your Social Security will eventually be taxable. So what is provisional income? Provisional income is all the income you get plus half of your Social Security. So that's what we want to talk about today. So let's use the screen. By the way, this is our team here at Bergen Financial Group. If we can help you with anything regarding your planning and making decisions, please contact us. We've got lots of good advisors, got a lot of good staff. My name again is Darcy Bergen of Bergen Financial Group. Darcy at bergenfinancialgroup.com or 480-430-2337 if you want to contact me. But let's get right into here on the board here. Let's look at provisional income. Provisional income is all of our income. So if I earn interest, dividends, and capital gains, I might want to reduce that. I might want to eliminate that before I get Social Security. I can move all the money from taxable investments to either tax-deferred investments or tax-free investments. What are the tax-deferred investments? Well, tax-deferred annuities. Now, I don't like very many annuities, but the ones I like are pretty amazing. No fees, 100% safety of principal, access to money, good indexes to choose from with no risk. Really good, but they're all tax-deferred. So if I earn my interest and dividends and capital gains inside of this bucket, it doesn't affect my provisional income. So that's tax deferred. Now, if I move that money to tax free, maybe I've got IRAs, and IRAs produce required minimum distributions. I have to take money out of my IRA, and that's going to cause my provisional income to go up. I don't want that to happen at age 72, so I'm going to start converting IRAs to Roth IRAs. I'm going to do that before I turn Social Security on because I want to have no provisional income or low provisional income. So IRAs that are in the tax deferred column can be converted to Roth IRAs, pay the tax before I get to Social Security. Now, so I've got my taxable money here, which I might be moving to tax deferred or tax free. By the way, tax free could be using life insurance. And if it's done as a non-MEC, then it has tax-free growth, tax-free income, done right, and tax-free transfer to beneficiaries. So I can move money to tax-free as well. So by using the technique of just moving where my money is being held, how I'm going to pay tax on it, I can almost get to a tax-free income in most cases. So let's go to a computer software program and let's show you how this is done very simply. So let's go to a software program that we pay for, and here it is. Hopefully you can see this and you're not having to look at me, so this works out really well. But here's John and Jane Doe, and we're going to use 2021 as the year. And they were going to retire, and you can see that they were going to take $40,000 of Social Security. They were going to take $40,000 from IRAs. And what was that going to do? Well, guess what? That green dot shows that every time they touch an IRA, they're going to have to pay 22% tax. Now, guess what? They're not in the 22% tax bracket. They're in the 12% tax bracket. Well, why are they paying tax on that 22% and not 12%? Because 12% was what they paid on the withdrawal of the IRA. But because it caused their provisional income to go up, it caused an extra tax of another 10%, which was 22%. So we're going to change how they do this. We're going to go back in and we're going to eliminate the Social Security. We're going to take it to zero. We're going to delay it a few years. And then we're going to take $80,000 out of their IRA. And guess what? They only pay 12% tax. Do you see that? That red dot there? 12% tax. And guess what? We can ask the computer, what if we brought that to $105,000 of income from an IRA? Maybe even 106, 107. 107,000 I could pull out of my IRA and pay only 12% tax. So guess what's happened? I've got more money out of the IRA. If I don't need to use it to spend, I'm going to convert it to the Roth so that later I've got no tax ramifications from spending the Roth, or it goes to my kids tax-free. So the advantage of deferring Social Security is, from a tax standpoint, I can get a whole lot more money out of the IRA with a whole lot less tax. Now, because I deferred my Social Security, let's go back now and change what's happening in the future. Let's now go to down the road. We turn Social Security on. We're going to get 32% more Social Security because we waited, plus cost of living allowance. That's about 9.5 to 10% increase of Social Security each year. So my $40,000 turns into about $55,000. And now I'm going to take $15,000 from my IRA. Guess what, folks? See the red dot there? Zero tax. How much more can I take out of my IRA? So down the road, I could take $19,000 from my IRA that I didn't convert to Roth, plus my $55,000 of Social Security, plus any income from the Roth, and guess what? I've got a tax-free income for life if I do it properly. So that is a great way to simply look at how to do financial planning by looking at Social Security and how it's taxed, determining that, now making the right decisions. So you can bring certainty back into your retirement planning by simply knowing the tax law on the different scenarios of when I'm going to take money from what. Why would I convert to Roth? Because I could produce a tax-free income on my Social Security at the right time. Please don't hesitate to call Darcy. Call us, Bergen Financial Group. We're in Phoenix, Arizona. We do work in more states than just Arizona. So give us a call. 480-430-2337 is my direct number, and I'll set you up with a really good financial advisor that can help you. Thanks for tuning in today. And again, we've got other YouTube videos on other topics that you need to know about when you're planning for your retirement.